Most investors don't lose money because of bad luck, they lose it because they miss the warning signs. And once you learn to spot them, you'll never look at a stock the same way again. Because the truth is, failing companies don't collapse overnight.
Welcome to The Explainer, where we break down what's really going on. And man, if you're an investor right now, you're probably feeling some serious whiplash. That's what we're tackling today using tech giant AMD as our guide. So here's the plan. We're going to start with the market's wild ride, then zoom in on AMD as our case study. From there, we'll look at 3 possible futures for the company, explain why markets are moving so fast these days, and then tie it all together with the big investor takeaway. All right, first up, the market's wild ride. Let's talk about that V-shaped whiplash. 1 minute, it feels like the sky is falling, and the next, we're rocketing back up. So are you feeling it? Because it's completely understandable if you are. The swings we've seen, from just extreme fear one day to these explosive rallies the next, it can be dizzying for anyone, even the pros. I mean, just look at this number, plus 15.5%. That's the Nasdaq rocketing back up in just 11 trading days. 11! It just goes to show you how breathtakingly fast these recoveries can happen, and they almost always kick off right when the fear is at its absolute peak. So if you panicked and sold at the bottom, boof, you missed that whole ride back up. And this right here, this is why trying to time the market is such a dangerous game. Check out this stat. Missing just the 10 best days over a 30-year span can chop your returns in half. In half! It's wild, right? It just proves that the best days often come right on the heels of the worst ones. If you're sitting on the sidelines, you're missing the magic of compounding that really builds wealth over the long haul. Okay, so let's make this real. We're diving into our case study, AMD's rise. This is a perfect example of that crazy risk and reward dynamic we're talking about. And AMD has been on an absolute tear. We're talking 162% gain in the past year. Just incredible. It's been bumping up against its all-time highs. This is the kind of stock that makes headlines, for sure. But here's the deal with stocks like AMD. They are not for the faint of heart. That's just the reality of the semiconductor industry. These stocks can drop 50% one year and then turn around and shoot up 250% the next. It's the absolute definition of high risk, high reward. You need a strong stomach for this stuff. All right, so this stock is flying high. How in the world can we think about its future in a structured way, especially if you're worried about all this volatility? Well, the trick is to focus on the company's fundamentals, not the day-to-day price swings. So the big question is, what could be next for AMD? Let's try cut through all that short-term noise and explore 3 very different potential futures for this company. Okay, so this table lays it all out for us. It gives us a framework to think about this logically. You've got your bear case. This is what happens if growth slows down, maybe competition gets tougher. We're looking at 25% revenue growth. Then there's the base case, kind of the middle-of-the-road scenario, more in line with what most analysts are expecting, solid 45% net income growth. But then you have the bull case. And this is the scenario where AMD really crushes it, especially in the AI chip space, driving revenue growth up to 40% and net income up to a massive 50%. But here's the part that is just, kind of crazy in a good way. Take another look at that bear case. Even in the worst case scenario here, where AMD kind of stumbles, the analysis still projects a 20% compound annual growth rate. Think about that. What that tells you is that the company's core business, in data centers and gaming, is so strong that it creates this kind of safety cushion for long-term investors. And on the flip side, you have this, $2,000. That's the potential price target in that bull case scenario. If everything goes right, if they hit that 40% revenue and 50% net income growth, the framework suggests the stock could hit $2,000 by 2030. That's the huge, massive upside that has so many investors excited. Okay, so we've seen the potential in a stock like AMD, but also the volatility. Let's zoom back out and figure out why the markets are moving so fast. What's behind that whiplash we talked about at the start? So you can think of the modern market as having 2 giant engines strapped to it. On one side, you have the human factor. News, rumors, tweets, it all hits us in seconds, and millions of investors react in minutes, not days. On the other side, you have the machine factor. We're talking powerful trading algorithms that now dominate the market. They don't have feelings, they make math-based decisions that can kick off a huge rally or a massive sell-off, literally in the blink of an eye. And when those 2 engines, the humans and the machines, start working together on the way down, you get what's called the avalanche effect. It's a feedback loop. Human fear triggers a sell-off. That hits a certain price point, and the algorithms kick in, selling even more. That causes more human panic, and on it goes. The selling just builds on itself, pushing prices way, way down, until there's literally no one left to sell.
Okay, so that brings us to the big takeaway. After seeing the market's wild ride, looking at AMD, and understanding the forces at play, what's the bottom line for you, the investor?
All right, here's what it all boils down to. First, you've just got to accept it. This crazy volatility isn't a bug, it's a feature of the modern market. It's here to stay. And because of that, trying to time the market perfectly is, well, it's a fool's game. Your best weapon is a long-term focus on the actual company. Use a framework like that bull/bear analysis we did for AMD to cut through the day-to-day noise. And when you start thinking like that, something amazing happens. You stop seeing these violent dips as scary, and you start seeing them as what they really are, potential opportunities.
And that's really the final question I want to leave you with. If this kind of volatility is the new normal, if these V-shaped dips and rips are just the price of admission to the market now, how does that change the way you look for opportunities? Does it scare you into staying on the sidelines? Or does it make you laser-focused on finding those truly great companies with fundamentals so strong they can weather any storm? That's something really important to think about.
If you want to invest smarter and avoid costly mistakes like this, hit subscribe, because this is just the beginning.